Hi, we've spent a lot of time working with companies in Silicon Valley, and one of the types of companies that we see most often are startup companies. And they're quite challenging from a tax function perspective, from the standpoint that you're always looking for this sweet spot with respect to their tax function. We've kind of labeled it the Goldilocks Complex, from the standpoint that you don't want to, due to certain budgetary constraints and resource constraints, and also the uncertainty with respect to where exactly the startup company is going in terms of their operations and their goals. So you don't want to give them such a large tax function that it cuts into their budget and so forth. But you also want to give them enough tax function to where it will carry them seamlessly and smoothly as they progress and as they grow. So you're really trying to find this sweet spot, in which case again, their budgetary concerns are met, and their resource concerns are met, and the uncertainty is met, along with all of the necessary aspects of a complete tax function to take them on into their future endeavors. So the way we approach startup companies' tax functions in terms of Clifton Douglas is really to break the tax function down into three specific aspects. One is preparation of the tax provision, two is preparation of the tax returns, and then finally special projects and outsourcing of other tax aspects. So with respect to the tax provision, again, the question comes up, does a startup entity really even need a tax provision? And again, it depends on the facts and circumstances, but what we found based on our experience is that having a tax provision really helps the startup entity from the standpoint that even though they're generating losses, they don't have really much in the way of income, they may not even have a viable product or service right now, still they are generating deferred tax assets in terms of those net operating losses and tax credits, and also various accruals that in fact they're carrying forward in terms of deferred tax assets that we need to preserve and we need to perfect in order to carry those forward so that the company can utilize them in the future to offset taxable income. So that is really helpful from the standpoint of putting together a tax provision so that you can understand what the deferred tax asset is and make sure that it's being preserved and carried forward. Also, from a company operations standpoint, just having that tax provision is really helpful to management in terms of understanding the financial status of the company. The provision is a reflection of all of the key financial data from the company, so you understand if the company is in fact, if their losses are increasing, if their losses are decreasing, and what is really driving those increases or decreases. Are they approaching profitability, and do we have enough in the way of tax attributes to offset that profitability? Does it make sense, when to release valuation allowance? Just all of that stuff is organized in a very nice format with respect to the tax provision. It's easily reviewed and understood by company management. And then also just on a going forward basis, so that once the company actually pops or actually becomes very profitable and starts growing rapidly and so forth, they're not sitting there trying to piece together a tax provision based on old data that they've got to reconcile 5 years back. It just makes no sense, and it creates all these opportunities for certain problems and issues to arise. But if you start out with a simple but a good tax provision, and you keep adding on layer upon layer upon layer each year as the company progresses and grows, you're just going to be all of a sudden ready for the time in which case the company just grows and just is becoming profitable. It's just going to be ready for that transition. So we tend to recommend a tax provision in many situations, but of course it does depend on the facts and circumstances related to the particular startup company. Then the second facet is with respect to the tax return preparation. And again, it's much like the tax provision. All the startup companies usually have is the filing of a federal return and then whatever state jurisdiction in which case they have their headquarters. In our case, it's usually California because we're dealing with Silicon Valley. Most of our companies are based out of California. So from that perspective, they're looking at filing a federal 1120 for a C corporation, and then a Form 100 for California C corporations in terms of income franchise taxes. So it seems rather simple, but again, just like the provision, you're carrying forward those tax attributes on and calculating those tax attributes to a certain extent on that return. So you need to make sure that it is in fact accurate and that all these carry forwards are going through smoothly and that they reflect the tax provision, that there aren't any major differentials between the tax provision and the tax return. And then also there are all these various business incentives that are available to new businesses and startup companies that you need to capture on the return itself. Again, the company won't be able to utilize those right off the bat, but you're preserving them for, in the terms of tax attribute carry forwards and then ultimately deferred tax assets, to offset taxable income and tax liabilities in future periods. So that's very important. Also, just getting down the basic process related to tax returns in terms of filing deadlines. If you're dealing with a calendar year-end taxpayer, you've got to understand that you've got to file by March 15th for the extensions. And then you also have to understand that you have estimated payments that are potentially due on a regular basis. And then you also need to know the deadlines for the returns themselves, which is September 15th if you're dealing calendar year-end taxpayer. A fiscal year-end taxpayer, again, you're going to have a little bit different deadlines just because of the fiscal year-end. But this allows you to really practice and put in place a process with respect to your tax returns and also link them to your tax provisions so that you can be certain that in fact all of these DTAs, which are going to be very valuable when you turn profitable, are in fact preserved and are being carried forward accordingly on the provision as well as the returns. Now finally, with respect to special projects, really the only two special projects that startup companies are going to be interested in is an R&D credit study and a 3D2, 3D3 analysis, because these two relate to deferred tax assets from the standpoint that an R&D credit study really tries to provide all the documentation supporting the credit and making sure that that calculation is in fact accurate. Well, at this particular junction, because the company's R&D credit is probably not that complex, they don't have that much R&D activity that's going on, an R&D credit study, which can be very time-consuming and costly, is not really necessary. But a high review of the R&D credits themselves is definitely warranted and often encouraged, and it allows the company to gather the supporting data on a regular basis so that they're not scrambling when they're actually trying to do a study or they're actually trying to utilize these credits to go ahead and support them out, that they're actually carrying forward that supporting data on a regular basis and that they're reviewing the calculations to make sure that their calculations are in fact accurate. But again, a study is not necessary at these stages, but just a high-level review is very much encouraged. Same with 3D2, 3D3 analyses. You're going to have changes with respect to company's ownership. I mean, as soon as the startup company really goes into operations, you're going to have various financing rounds, and each one of these financing rounds really, from my experience, has a great potential to trigger a greater than 50% ownership change, which results in a change of control and triggers 3D2, 3D3 tax attribute limitations. So you need to understand, again, from a high level, what your 3D2, 3D3 impacts are and whether or not you're limited in terms of your tax attributes. But does a study need to be performed, a real in-depth study that's costly and very time-consuming regarding 3D2, 3D3 at the startup stages? No, not necessarily. Really just a high-level review usually is enough to go ahead and carry those tax attributes forward adequately. You might have to have reserves, ASC 740-10 reserves, on these tax attributes, but again, that's all part of the high-level analysis, high-level calculation. Once you actually become profitable and you grow extensively, certainly a more in-depth analysis may be required, but once again, you've already prepared from a high level all the necessary supporting documentation and analyses that you need, so that as you carry these analyses forward, if you actually have to do a full-fledged study in the future, you'll be that much better prepared rather than scrambling saying, we've never put anything together before on this, we've just been carrying it forward. It's going to be a lot easier to deal with the study if you have prepared some analysis, rather than if you've got to go back 5-10 years to gather data to put together the study that isn't readily available. And then also with respect to outsourcing, we talk about income franchise taxes here, but really indirect taxes, there can be time consuming, and there's a lot of complexity surrounding them, like sales use taxes, payroll taxes, property taxes. So from the standpoint that you can just outsource those to your tax service provider, it just takes a huge burden off of your shoulders. Also, with respect to dealing with tax notices on a regular basis and audits, it just, from my experience, makes sense to go ahead and outsource that to your tax service providers, especially if you're operating with a very lean and mean, a tax department when you're a startup entity. So again, we've dealt with assisting startup companies in terms of developing their tax function for many years at Clifton Douglas. And certainly our objective is really to find this sweet spot that really helps startup companies from the standpoint that you are providing them enough of a tax department that will carry them through the changes that they're going to experience as they grow, but you don't provide so much of a tax department that it drains resources, that it drains funding, and that it takes the company's focus away from operations. So really finding that key area, that sweet spot, is our goal. So certainly if your company needs help in this analysis in terms of really finding that sweet spot for their tax function, give us a call, or you can find us online. We are at cliftondouglas.com. Thank you so much for watching, and have a great day.